Okay, welcome back. Back here with David Ryan, Master Trader Program Super Performance Workshop. Just real quick, we're going to recap what we went over so far. We went over categories and catalyst valuation. We talked about the trend, the four stages of a trend. Now we're going to get into some fundamentals, what we call fundamentals to focus on. We're going to look at what attracts institutions into a stock. And I want to point out that we're going to look at these various variables or parameters, if you will, in kind of slice and dice them in a bunch of different ways. But through all this next segment, we're only going to be focusing on three things: earnings, sales, and margins. Like I said, we're going to be looking at them from different angles, and I'm going to show you a bunch of different ways to analyze them and slice them and dice them and apply them to various scenarios. But we're only gauging earnings, sales, and margins. And that's really all you need to look at. When we're talking about growth stocks in particular, you don't need, all this other, book value and all these ratios. And you really, if you can get good and pretty much, through this whole entire workshop, if you could get good at the things that we're showing you, where price, volume, some moving averages for smoothing, making sure you're in a strong uptrend, earnings, sales, margins, and you apply all this properly, you're not going to need anything more. Dave, you've been doing this a long, long time. Between the two of us, I don't even know how many years now. I don't want to even think about it because it scares me how old I am. But you've been doing this a long, long time, and you worked with one of the best on the face of the planet, William O'Neill. How complicated did he make this investing equation? As far as using the various aspects that all the tools that we have to work with. There's so much information now, and there's so many things to look at. What did O'Neill boil it down to, and what did you boil it down to all these years?
Well, it was basically the CAN-SLIM characteristics, and those were the characteristics of the greatest winning stocks of all time. And I keep on saying the market is not that complex. You just have to really simplify it down to as what we're discussing in this whole workshop, but then also add in your own life. Where are you shopping? What products are you buying? What are your friends buying? What are the trends in the marketplace? And you just combine your life with these sets of rules, and you should do really pretty well in the marketplace. It takes a while to get up to speed with all this, but doing those two things, combining those two things, you'll have some good success.
Yeah, nothing has really changed. Now, there's no special set of business dynamics that are different because a company is public versus that it's not public. It's the same business dynamics that drive a company to grow larger and to be successful. If you go back, to the 1920s and 30s, Coca-Cola was like Monster beverages today. You can go back and look at one time there was hundreds of car companies where car companies, before it was boiled down to GM and Ford and Chrysler and just a few, there were hundreds of car companies. They were like high-tech companies. So you go back, even in the internet phase, we had all these internet companies, and then it boiled down to just a few. This is the same business dynamics that take place, and it basically all revolves around. There's three ways that a company can grow the earnings, and growing the earnings is going to grow the stock. Now, if you can figure that out, that's great. That's Peter Lynch and a lot of these guys, these fund managers that became legendary investors. They're trying to figure out earnings growth, right? So there's three ways: sell more, raise prices, or cut costs. Now, there's some things that you have to know about this. So, for instance, you can sell more of an existing product, right? Or you can raise prices, or you can sell a new product and sell more product, but you're selling new product, or you can cut cost and you can rid losing operations. You can improve productivity. Here's the thing to realize, though. If you cut cost, there's only so much you can cut. After a while, you cut cost and there's no more to cut. You've got to grow the top line to grow earnings. So you're going to have to grow revenue. You ridding losing operations, increasing productivity. All that's great. And when you combine that with the growth of the sales, this is where it gets very powerful. I'm going to show you in just a minute on how all this works, and it's going to make a lot of sense to you, and you're really going to be able to see the power behind getting really good at knowing how to analyze these few metrics and put them all together. Now, we showed you the 4 stages of a stock's maturation cycle from a technical level, right? Stage 1, stage 2, stage 3. Stage 2 is where we want to be in, right? We don't want to, certainly not stage 4. That's the declining phase. That's where you be looking at the shortest stock. Stage 1 is the neglect phase. Well, when you look at the earnings cycle, it's going to fit in with this maturation cycle. And basically what happens is and another thing I should point out here is that if you're a value player or you're a growth player, you might be operating in a completely different part of the maturation cycle. So for instance, value stock buyers are going to be buying the stock when stocks are in stage 4 and when they're in stage 1. And a lot of these guys, someone like a Bill Miller, it might be selling a stock when the stock is in stage 2, might even be selling it in the early stages of stage 2. And you might be buying it at the time that they're selling it, but you can both make money. Right, it's just a different style. Now, I don't know anything about value investing. That's not my forte, but I know everything about what I do, and that's the key: is for you to learn everything that there is to know about the way you do it. So let me explain to you what happens here with this earnings maturation cycle. So you start off with basically a stock that's been neglected. It's in stage 1, and then suddenly something happens. And this is sort of the N in CanSlim. Now, this isn't a CanSlim seminar, but I could tell you right now, there's a lot of overlap. We're just building upon previous work. I'm building on work that started with Jesse Livermore and then Richard Love in the 60s and 70s, and then William O'Neill. And I'm sure some of you will be building on my work and David's work going forward. So this is the same thing that's been working for years and years and years and decades. At some point, there'll be some positive development, whether it's a change in the business dynamics, and it'll show up in the earnings, and you'll get the earnings to come out better than expected. And now you've got computers. These institutions run these computer models, and they'll pick this up with a surprise model. From that point, analysts will start revising their earnings estimates up. And this is what creates momentum in the stock. And then you start getting EPS momentum, where you get acceleration in the earnings. And now the stock goes from a value stock that was neglected to a growth stock that's taking off and making a big move during this part of its cycle. Now, on the flip side, the exact opposite happens. You get a loss of EPS momentum. It starts to stall. You start seeing deceleration in the earnings. You get a negative surprise. Negative models pick it up, and now the stock is sold off. Institutions start dumping the stock. Estimates are revised down, and now you're right back to a value stock again. And you're selling the stock, and now the value people, they might be entertaining buying the stock at this point. So this maturation cycle, again, this is also part of an overall perspective, but it's really important that you understand how this works.
And Mark,
go ahead.
I just wanted to add, if you go back to that, I know you wanted to build and that's a great example of what's going on. But lots of times, a stock will actually, on a price basis, will have already started rolling over, and really even start into a downtrend before you actually start seeing that loss of EPS momentum. Because I've seen so many stocks that have been down 50% off their highs, and then they come out with that bad earnings report. Right. So the price of the stock does not always fit exactly is what's going on. It could be a little, some of these things could be a little shorter, a little bit earlier, a little bit later. And so that's why I've always said, I buy on fundamentals and technicals, and lots of times I put most of my weight on the sell side, on the technicals. But this is, this is a model of exactly, I mean, what's going to happen, but maybe not in exactly that type of timing.
Right. And I'm going to point something out because I think this is the 8th year that David's been doing this with me. And every single year he goes ahead. And we're going to get to that in a minute, but David always does this. He moves us ahead. So we are going to get to that in just a little bit. David's absolutely correct. And we'll point it out in just a minute. We're almost there. So let's real quick here just look, and I'm just giving you perspective right now. Earning surprises are going to drive your earning surprises are going to drive your stock, and this is what produces what we call post earnings drift. And the reason why you get post earnings drift, see, the thought that the market is efficient. Yes, it is efficient a lot of the time. And in some areas, it's very efficient. But there's other areas, and these are the areas that we're going to show you the traffic in. There's areas where it's not efficient at all, and it's very inefficient. And the reason why is, and it's all based on post earnings drift or post news drift of things that happen with the company that can't be fully discounted. Let me explain to you how that happens. So earnings are revised, all right? Or earnings estimates, stocks move, and analysts, make their decisions based on what they think a stock is going to earn, and then they put a PE multiple on that, and that gives them valuation, and they can figure out where a stock should be and where it is, and whether it's undervalued and so forth or overvalued. So the problem with this is that, number one, analysts don't want to risk being wrong. They don't want to risk. They're basically protecting their job. So what they do is they sort of crowd around the average. So if there's 10 analysts, I mean, something like Coca-Cola might have, 50 analysts following it. The average, estimate, let's just say, is, $1.32 for the year. So if you were to go and make this outlandish, estimate that it was going to be $1.78, that would be taking a big risk, because now you're way away from the herd and you're going rogue. So what happens is they're very conservative. So the companies can beat these estimates, but now that's also figured out too. All right. There's the whisper number and all these things where, analysts are pretty smart, and these people that are, at Fidelities and these big companies, these teams of, MBAs that are, forensic accountants, they're pretty smart. So they can even look beyond that. But the one thing that they can't look beyond, or they can't figure out, is that when you have a company that's growing its earnings at a very rapid rate, let's just say, 50% or 100% per quarter, there's no way that you can put an appropriate PE, or you can forecast where that stock's going to be 4, 8, 12 quarters down the road. Even the CEO himself has no clue how long they're going to be able to deliver that type of earnings. Now, Cisco delivered triple-digit earnings for 16 consecutive quarters. You do the math. Let's just say that you had you had a company, you had a small, plumbing business or something, and you were doing $500,000 in sales a year, or $1 million in sales a year, right? Just take that times 100%, times 16 quarters, and take a look at where your company would be. You do that for very long, and you're a Fortune 500 company in not too long. It's really quite incredible. I want to show you. Let's do some math here real quick. I actually put this slide together at the very last minute just to show this point. So let's just say you start off with $100 per share. All right, $100 per share in earnings. And analysts can figure it out pretty good that 4 quarters is going to be triple-digit growth for the next 4 quarters. So if you took $100 times 100%, you'd have 200, then 400, 800, 1600, right? So 4 quarters a year later, the earnings are 16 times higher. But now, what about the visibility out another year? What if the company was able to do that for another 4 quarters, but you weren't really sure about that? You weren't sure about that estimate. Okay, let's do it 4 more quarters. Now we go 4 more quarters, and now it's 256 times. The earnings have grown 256 times, as opposed to just 16 times in the first 4 quarters, because this is compounding. Do that in another 4 quarters, like Cisco, well, actually, Cisco did it for 8 more quarters. The numbers are astronomical. And that's why Cisco systems went up 70,000% during that bull market. That's why in Amazon, it's gone up 80, 100,000%. It's because of the earnings growth. And the reason why it could keep going, and it doesn't get everything's not baked into the cake where you can say, oh yeah, I mean, this is where they're going to be in 5 years. And the stock has it all priced in, is because there's nobody, not even the CEO himself, can know that those type of earnings are going to sustain themselves. So,
and Mark, I would also say that in this this day and age, I forget what year where, and it was it regulation T or Reg T, where analysts, where companies had to, any information they're going to put out there has to be put out to the whole public.
Right.
Where in the past, the CEO could sit down with an analyst and kind of wink at him and say, well, I think our numbers should be right around here. But now none of that, I guess, exists. And so I think it's even harder for analysts to know exactly what their earnings are going to be a quarter or 2, 3 quarters out.
Yeah, absolutely. Like I said, there's no business dynamics change, and they can change for the better, for the worse, or they can, stay the way they've been and have a company dominate an industry for a long period of time. I mean, who would have ever guessed, what Amazon is doing? I mean, Amazon was hated. The analysts said that Amazon would never even make money. They said that in the 1990s, in 97, when I was buying Amazon, the analysts said that Amazon was never going to be profitable. I mean, boy, did they get that one wrong. So now we're showing you about, there's a really important point here. And that is, and again, we're going to get into what David was talking about also, about selling on technicals. And there are some caveats to these numbers. The rule of thumb is that as much as we're going to show you all these numbers and how to slice and dice them, the rule is never trust the numbers. Never trust the story, no matter how good the story is, no matter how great it sounds, no matter how great the numbers are, whether there's triple-digit earnings and sales every quarter, no matter what those numbers are, you're never going to trust those unless they're confirmed by price action. So, for instance, you're not going to, we're going to, everything we show you, you're not going to apply this to a stock that's in a stage 4 downtrend. And something that I should have said before, and I need to say now, everything that we show you in this entire workshop, it's in chronological order. Everything we show you going forward, everything afterwards builds upon the previous lessons. So nothing negates what we told you previous. So if we say stage 2 uptrend, well, going forward, everything is applied to stocks in a stage 2 uptrend. If we tell you, X, Y, and Z, everything going forward is going to be applied to a stage 2 uptrend and X, Y, Z. It's all chronological and all builds on each other. Okay. Very important points. Dave, let me ask you a question. I mean, no matter, I think I asked you this before, but I mean, no matter how good we see these numbers, and no matter how great, how popular the company is, or how, quality the company is, are you buying these stocks if the technicals aren't there?
No, your stock has to be starting into an uptrend, and the story and the numbers always have to go along with what you're seeing in the market. And if the stock is going down, but you hear this great story, wait until the stock starts turning and getting into an uptrend. To me, I don't care if the CEO lives next door to you and he's telling you all these great things about the company. Only if that stock is in an uptrend should you be, buying that stock, because he's always trying to promote and trying to build up and say great things about his company. So no, I mean, times where I've lost money is where I get so enamored by the story that I start fudging on the technicals or even on the numbers. And it turns into a loss.
Yeah, it's so funny because I pound the table on this particular point, and I remember O'Neill pounding the table to me, and basically just saying, because I was at at one of his workshops, and somebody was just peppering him. I mean, you remember with O'Neill, he would just rip people apart, worse than me, and I can rip people apart in the audience. But I remember someone was just pounding him about, yeah, but the numbers are great, and he just said, look, if the numbers are so great, the story's so great, why isn't the damn stock going up? I mean, come on. What are you stupid? He said. Why isn't the stock performing? If everything's so great, why isn't the stock performing? You have to have some respect for the intelligence of the market. I assure you that the stock is going to be right way more often than you are. That I can guarantee you. Now, here's something where this is sort of a unique way I apply a term, or I guess a technique that's used in forensic accounting. If you ever heard the word, those of you that are accountants would probably know the term differential disclosure. Differential disclosure is simply where you look at documents, and you might look at the company's annual report, and then you read the footnotes, and you look at the SEC filings and the tax returns, and you start to see if things add up. And if they're not seeing the same thing in the reports to the government and in the SEC reports as the reporting in the annual report, that's a red flag. That's called differential disclosure, where things aren't matching up, because when in the annual report, there's no regulation as to what you have to report in that. But when you report to the SEC, there are strict guidelines of exactly what you have to report and how you have to report it. So the forensic accountants will go in there and they'll read those documents and see if there's indiscrepancies, and they'll read all the footnotes. Well, now that's something where I'm not using forensic accounting, but I apply differential disclosure in another way, and I look at it simply, and it's basically like what O'Neill was saying. I took that to heart and started studying these stocks and seeing that so often you'll get stocks will act completely different than you would ever think based on the underlying fundamentals. Here's a perfect example. Crocs comes out with earnings up 144%. And the stock gets annihilated. It has the biggest down day and the biggest down week since the beginning of the move on the largest weekly and the largest daily volume, which is a major sell signal. When you have a big move in a stock, and you have the largest weekly down move on the largest weekly volume, or even the largest daily move on the largest daily volume since the beginning of the move, those are institutions running for the exit. Something has changed. Now, that report, no matter how rosy it looks, no matter how much it's making news headlines, and it's up 150% and they beat estimates, if that stock reacts that poorly on that, that's not a good report. You have to trust your eyes, not your ears. So go ahead.
I was going to say that was a stock that I was in, and I did very well off that stock. I sold most of it before the stock before the earnings report, because it had such a great run, but I still had a small position in it. And then it got clocked. And I think they were saying that the earnings were going to start slowing down. But you can see, even though I suffered a loss on that last remaining shares that I had, I mean, I guess looking at the chart on the right side, you can see, that sale is just an unbelievable sale, because the stock almost went under. I mean, it almost went to zero.
It was down, well over 90% after it had that big decline. Now, here's where we're going to go into what David was just talking about earlier, was that very often what will happen, and same thing in the case of Crocs, you have where the stock tops, but the bad earnings don't come out yet. This happens all the time. Sometimes you'll get a whiff of deceleration. And in this particular case, you can't really call triple digit going from 333 to 144 really deceleration. Once you're at triple digit earnings, those are huge enough earnings to be considered great earnings regardless. However, you can see as the quarters go on, look where the bad earnings come in, the negative earnings come in after all the damage is done. Almost all the damage is done, and then all of a sudden, now comes the bad news.
Yeah, and I've also found too that when stocks surprise, when they have great earnings growth and it's much greater than expected, that after about 3 of those surprises, people start catching on and the expectations get higher and higher. So you have to be careful after the stock has surprised for 3, even 4 quarters, that look exactly what happens when the earnings are reported. What is the reaction with the stock?
Right.
And that can give you a clue to the direction.
Here's a stock that I was in coming off the 1990 bear market. I bought Vicor coming out of an IPO base. And you can see, again, look at the earnings. You get these big triple-digit earnings. That's what's driving the price of the stock, because, again, this can grow the company at such a rapid rate. And then after the stock gets clocked and it has this big, giant decline, now see the earnings. They come in. Now you get the 0%, +8%, -7%, -13%. Now all the growth's gone, but it's too late. Just like Dave said earlier, selling on the technicals. We have a whole entire section on selling, and we're going to give you a bunch of selling rules and all that. So we don't want to jump ahead too much here, but right now we're just going to show you the fundamentals and exactly how to apply them, and then we'll bring everything all together going forward. But I just want to show you some of these examples. Here's another one where stock breaks on a good earnings report, quote unquote good earnings report, right? EPS up 46%. 38% versus 37. They beat estimates by a penny, not by much, but they beat estimates. Sales up 36%. Estimates were for 282 million. They came out with 288 million, so they beat estimates there. Stock gets killed, right? Look at this. Later on, after it goes down, it turns into a serial gapper. Big giant gap. Now the stock's down, I don't know what percentage here, but huge. Now the pain comes on the earnings. Now EPS down 27%. Sales negative. See, this is where the stock is discounting. It's discounting the future, and institutions are running out of the stock. This is the exact opposite. And what stage is this? Take a look right here. What stage is this going into? Stage 4, right? That's why you don't want to be in stage 4. You don't want to be anywhere around in stage 4. Now, also, company issued guidance. This can also act like earnings. Companies will come out and they'll pre-announce and they'll give guidance, and this can also move the stock, and you might even get a good earnings report. So here, and a lot of times a company will do this. They'll wait when there's a great earnings report, right? They'll have a good report, and then they'll give the bad news with the good news. This is never going to trick Wall Street. So they're going to figure this out, and the stock's going to react. So perfect example was Netflix when it had a top here back in 2011. So earnings 57%, beat by 14 cents, but they guide lower. Stock tops. Now it comes off hard, right? EPS 66%. They beat by 22 cents, but they guide lower again. So this, again, guidance was really telling the story here. So you gotta treat, like Dave just said, it's the reaction. It's the reaction to the guidance. It's the reaction to the earnings, and you've got to get good at deciphering this reaction and putting 2 and 2 together. Does it make sense? Does it make sense that this company's coming out with this huge earnings report, but the stock's down 15%? That doesn't make sense. Differential disclosure, right? There's more examples here. We can pass over this just for your own edification. But here's another thing I want to point out here, and this was really a good or this was really something that in the 1990s, when we had the dot-com era, there were a whole bunch of stocks that, if you go back, there's some videos probably on YouTube that I was on TV shows saying that these companies have nothing to offer and they're eventually going to go bankrupt. However, it was a huge opportunity in it because they were very popular and they were trading on the prospects of a new technology, a new industry, the internet. And a good company doesn't necessarily make a good stock, and a bad company sometimes actually makes a good stock. If they're growing the earnings or they're growing the sales, or even sometimes you don't even have earnings and sales, and the stock is doing so well because the industry is so hot. Here's a perfect example. Macy's is around since 1858, 130,000 employees at the time, 25 billion in revenue. Tilray, founded in 2013, 330 employees with 28 million in revenue, virtually a non-existent company on the stock in stock market terms. Stock advances 1,000% in 5 weeks. Okay, so again, now what I really want to point out is the reverse of this, because so many people, and Dave, I definitely want you to chime in on this. How many people do you think now are going to be buying Amazon, when it finally tops someday, and Amazon and Google and Netflix and PayPal and Facebook and all these nifty 50 stocks of the new age, FANG stocks, if you will, when they top and they're down 30, 40%, how many people do you think are going to be in there buying the heck out of them, think they're getting a bargain, doing exactly what they did, what I showed you earlier, the broken leader? You want to stay away from the broken leader? That's exactly what's going to happen. We're setting up a whole generation for huge losses because they're going to think that a good company makes a good stock and ignore stage 4.
Yeah, and that's something that we've, I've mentioned earlier, Microsoft, one of the greatest companies around, but went sideways to down for 16 years. So you always get that out of your mind, the difference between a great stock and a great company. You want both. You want a great company, you want a great stock. If you can get both of those, you're probably going to have a great move. But as you said, I mean, it's amazing. Some of the companies, even now, that have had big moves and they don't really have great fundamentals.
Right. So now here's where the real power comes. And I think I've asked you this before, Dave. When you go back and you take a look, O'Neill played for the big moves, and he'd build big positions in some of the key leaders. How many times was O'Neill in a stock and building a big position and staying with it for a long time in a company that didn't have the earnings?
Oh, I can't even remember him being in a stock that didn't have earnings. I mean, even something like Amgen, it started off, and I guess, it got approval and it started up, but they quickly started, making tens of hundreds of millions of dollars off their new drugs. So
Amgen was making money. They had earnings.
Yeah, they did have earnings. Yeah. And so every example I can think of were stocks that had earnings.
Yeah. And so now, the reason why, again, when we go back and you look at what drives stocks, it comes down to earnings. And it's either, it's either expectation of earnings or the actual earnings themselves. But what we found is, by looking at and studying history, is that 70%, 7 out of 10 of the biggest winning stocks and the fastest moving stocks, the earnings are already on the table. They're already reporting strong earnings. So the majority of time, you don't have to guess. See, that's the thing. You don't have to guess. All you have to know is what a stock has done. You don't need to know where it's going or what it's going to do. You just need to know what it's done and what to expect and get good at responding. So one of the things that we look for is what we call quarterly earnings acceleration or sequential acceleration. And again, another benefit of using a product like MarketSmith, where they're going to figure out below the chart, you're going to see 4 quarters. And we're going to get into looking at MarketSmith charts later, but you're going to get the 4 quarters, and they're already going to show the year-over-year percentages, because you're going to compare year-over-year for each quarter, because that takes out any kind of seasonality and all that, and you're comparing apples to apples. And then from there, sequentially, this is where you want to see acceleration. And acceleration can even be going from negative to positive, and then from positive to even more positive. And you can even look forward and look at the estimate for the next quarter and see if it's even estimated that there's going to be acceleration. I always look at 1 or 2 quarters going forward, as well as looking back 4 quarters. So you want to see that acceleration. Again, most of the stocks that are going to make big moves, 95% of them are going to have some type of acceleration, whether it's the sequential acceleration like I'm showing, or there's a couple other types of acceleration I'm going to show you here in just a second. But let's take a look at what sequential acceleration looks like in a real life example. So here's Gilead, right? So you can see from 4% to 10% to 208%, even the revenue, 15%, 21%, 97%, and then going forward a quarter. All right, if you were just looking up to here and looking at this base being forward, then even the quarter after that, 372%, up 136%. This is what's driving the stock. This is what's driving the stock higher, and this is what's bringing institutions into the stock, is this acceleration. So this is stock that I bought. I bought right here. And again, we're going to go into the technicals later. This is just a big classic cup with handle, has VCP characteristics. Those of you who follow me know what that means, and we'll explain it soon. But also looking at earnings. Here's F5 Networks.
And one other thing I would like to point out on that example is that these are actually, they're making, a lot of money per quarter. That's 55 cents versus 50 cents, $1.48 versus 48, and 236. You just have to be careful on some of the ones where you see some huge gains, but it's 2 cents going against 1 and 3 cents going against 2. It's actually even better if you've got a company that's making that has some size to those earnings.
Yeah, and we're not talking about going with just mega cap companies. You can, small cap and medium cap are great. We love those. But what David's pointing out, and I think we should even add to that, is that we want to stay away from the penny stocks, the $2 stocks, the $3 stocks, and now they're reporting 1 penny versus 2 pennies in earnings, and the low price stocks. The reason why that you want to stay away from the really low price, particularly under $12, starts entering into what we would call the junk pile. And then when you go below 6, you really start to get very speculative. Let me tell you why real quick. Let's digress here for a second. So when we want institutional sponsorship, right? Institutions, we already established that those are the big dollars that come into the stock that can move the stock and keep it moving and have a sustainable move. But when you get down and you're into the $6 range, now you can only have funds that are low priced funds. These funds have mandates. They have certain quality mandates. So they can't just buy those stocks. Many of them can't buy them at all. They have certain price restrictions. And you start getting down into the very, very small names and the lower quality, you're eliminating a huge portion of your institutional sponsorship. That's number one. If that's not a good enough reason, it also, the stock being that low priced is telling you that it's of lower quality right there. So now you're in a lower quality. And the third reason is when you get down into that low price, the volatility is much higher, because a stock just has to move 60 cents on a $6 stock, and that's a 10% move. Where on a $100 stock, of course, it would have to move much more. Percentage wise, it's the same, but lower price stocks are going to be much more volatile. So there's just compounding reasons to stay away from the lower priced issues. Let me show you F5 here real quick. So again, you're not only looking for earnings acceleration, you're also looking for acceleration in sales. And here's the real important point. When you bring this all together, what we're showing you here is how to maximize not only the probabilities, but also maximize the power of putting all these rules together. It's not 1 + 1. When you take and you start stacking, it's what I call stacking probabilities. When you put acceleration in earnings, sales, margins, the trend in an uptrend, coming out of the right price formation and at the right buy point with the right volume characteristics, you're stacking probabilities. It's multiplication now. It's not 5 things are 1 + 1 + 1 + 1. It's multiplication. It could be by adding 3 probabilities and stacking them, you could have a 50 times greater probability or 100 times greater potential of a big move. So this is all about getting as many elements and as many probabilities in your corner. Now, I also want to bring us back for a second here. We're only talking about earnings, sales, and margins, right? Because we're starting to slice this in a bunch of different ways. And you might be saying, whoa, this is a lot here. All these things, acceleration and looking at analyst revisions. No, we're just looking at 3 things: earnings, sales, and margins, but we're looking at them from a few different angles. Not a lot of angles, maybe 4 or 5 different angles, and you're going to apply these in different scenarios. Okay, so here's Kenneth Cole Productions. Again, you see the acceleration here. Now, another thing we should point out is that acceleration doesn't have to be so perfect where it has to be every single quarter. You take a look at here, you've got sales up 29%, then 49. Okay, you got one at 31, but then it's right back up 56. So you're seeing a general trend of acceleration. Same thing in earnings, 41 to 117. Okay, next quarter is 48. That's still great earnings. And then it comes ripping right back 283%. Excellent fundamentals here. I bought this stock right here. Coming out of this base, it made a very nice move. You always want to also look at a weekly chart. And like I said, we're not getting into charting yet, but I just want to show you how the weekly chart also is going to be consulted at all times. Every time when you look at a daily, you're going to look at the weekly as well. Let's look at Facebook here. So two things about this chart. One, here's the new issue. Some of you may have been around when Facebook went IPO, and you remember that this was a very anticipated IPO, and it was a flop right off the hop. It just came right off, and the stock just cut in half, and it was just a disaster. This happens a lot of times with very highly anticipated IPOs. LinkedIn was another one that just did terrible in the beginning, and it took, I don't remember, a couple years before it got its act together. And then I bought it later on, and it did very well. Well, Facebook is another example. Look at the earnings. You see earnings 0, 13%, 0. Revenue was good, but it wasn't translating into any earnings. But then look at this. All of a sudden, the stock explodes. And look at the earnings, 58, 108, 82, 183, 121. See, this is where you start compounding. Look at the revenue, 53, 60, 63, 72, 61. Big numbers. Now, another thing that I do, if you don't have every quarter accelerating, perfectly, I sometimes just look at a 2-quarter average, and I want to see if the general trend. And if you took a 2-quarter and you average each 2 quarters, you see 6, 29, 83, 95, 132, 152. You have perfect acceleration, and that's what's driving the stock. Okay. Look at here. Here's a couple other examples, and I'm showing these examples because I want you to see, going back to what we talked about earlier, where you don't know how long this is going to go on. Here's a stock. Here's Vicor, the stock that I showed you I was in earlier. Average quarterly growth through this stage 2 uptrend was 130%. It's a huge number. And it went on for 1, 2, 3, 4, 5 quarters. So that just 5 quarters of this kind of growth can propel a stock like this. So imagine if there's 8 quarters, 10 quarters, 12, 15 quarters. Just amazing what can happen. Here's another one, triple digit, of course, in Crocs. Now, again, they weren't good enough at the end, and we got that differential disclosure. But during the stage 2 uptrend, up 229% was the average quarter. That's why it made this big move in such a short period of time.
And I think it's good to keep in mind that the average big winner before you get into a bear market, or if the stock itself peters out, is usually about 1.5 to 2 years. And also, when you think about it, it's hard for a company to keep up this type of growth. I mean, as you mentioned, there are the Ciscos that go for 16 quarters like this. But for the average company to keep this up more than a year and a half at this rate is very tough, because they have to come up with either new products, or they have to raise prices, or they have to do something, cut costs with their margins going up. But it's just hard to sustain this for a long period of time. But this is the time that you want to be part of that stock, though.
That's right. And what David's saying is that you don't have to find the stock that's going to grow these earnings for the next 10 years and find the next Amazon, because you can get. And what we're trying to do is we're trying to get the big winners that make big moves in the shortest period of time. We don't want to hold a stock 10 years. We'd like to hold a stock for 6 months if we can, and make a big move and then go on to the next one. So there's an opportunity here. There's an opportunity, but also you have to beware that when this growth ends, that you see what happened here, right? So the stock tops, and that's why we're going to adhere to making sure that we're sticking to only the stage 2 uptrend. But as I'm going to show you here, you don't need a lot of time in these stocks. They can make moves and make very big moves in relatively short periods of time. And the earnings are so influential that this was something that example that I always love showing. The NASDAQ went into this incredible bear market. If those of you who are around in 2000 to 2003 can remember, I mean, what a devastating, this is the worst bear market up until that point that I had ever seen. I went through the 87 crash. This was just unbelievable. The average stock, like Microsoft and Qualcomm and basically the FANG stocks of that era were down about 85%. And many of them still haven't come back to this day. 20 years later, they're still haven't gotten back to the original prices. Take a look at Apollo Group. We looked at this before. If you remember, Apollo Group was the one that was trading at 60 times earnings, had those 3 years of earnings growth that 3 years later, the stock was up 200%, and the PE was exactly the same at 60 because the stock went up 200%, right? Well, look at this move here from 2000 to 2003. This stock makes this big move, right? And it's in one of the worst markets in the history of the stock market. So even now, I'm not saying that you want to start going crazy and getting long in a big bear market, but this is the power of having accelerating earnings, what can happen and what it can do to a stock, even in the face of a difficult market. So now here's another stock. This is Home Depot. Everybody knows Home Depot. But I'll tell you, back in the 90s, it was particularly in the early 90s, Home Depot was not a widely known name. It didn't really get really popular until you got into the mid and late 90s. And this is actually a funny story that I've told. Some of you may know that I was an advisor to the traders over at Soros Management. And I went to go meet with, George Soros's people. And what happened was in the middle of the meeting, a manager came in and said to me, "What do you think of Home Depot? We're thinking about going long the stock." Now that was right over here after the stock had run up extensively here, and the earnings started to decelerate, and the stock started looking toppy. So he said to me, "We're thinking about going long, really, really aggressively, Home Depot." And I said, "Long Home Depot? That stock has made a huge move. It looks like the earnings are starting to top of the stock is in stage 3, almost a stage 4 downtrend." He said, "Hire that man, give him a check and hire that man. I was just testing to see if I could influence your decision." So I stuck with my guns, and I told the truth. I didn't try to placate them, and it paid off for me. But what I was looking at the time, okay, here's the moral of this story. Take a look here at the EPS right here. You're at 24% average EPS growth right here, right? Look at when you make this accelerated move. You see how the earnings accelerate, 37, 41. Now your average EPS is 39% for those 2 years. We're looking at annuals now, by the way, not quarterlies. We're looking at annuals. So through this whole move right here, your average annual EPS are up 27%. Now, the stock goes into stage 3 and then into stage 4 downtrend. And in typical fashion, the bad earnings come later on once the stock tops. Now, looking back in hindsight, it all makes sense, right? The stock tops, and for 2000 all the way out to 2008 here, 8 years later, the stock is still down almost at the lows and has gone nowhere but down. The earnings are about half of what they were through the period where the stock was marking itself up. And you can see way over to the right, this is where the earnings really start to come off here, just 3%, 8%. The stock has already discounted that, and the earnings have already averaged 15% versus 39%, less than half the earnings growth. So again, whether you're looking at annuals, quarterlies, you're looking for acceleration and trying to avoid the deceleration on all those time frames.
Yeah, and Mark, I see this a lot happening, especially in bull markets where stocks, they have great earnings growth, and they take the valuation of these companies up so high that going from 27 to 15, I mean that's a pretty big slowdown, but the company is still growing somewhat, but the stock gets so far ahead of the earnings that it takes a number of years for for the earnings to actually catch up to the valuation of the stock. And then the company usually has some problems, and they sort of have to reinvent themselves, or or come up with new products or new services, and then they take off and go again. But I see that happening in even some of the best companies that have multi-decade type of runs.
Right, and that is a great explanation for why we would sell on. David said earlier, we sell on technicals, not necessarily the fundamentals. We don't wait for the fundamentals if the stock's topping, because what happens is, like Dave said, this stock will discount and run way up real fast and top out while the earnings are still looking pretty good. And this is why when we'll roll back to the beginning, what I said, never trust the numbers, never trust the story unless it's confirmed by the price. So that works on whether you're just getting into a position or even whether you're going to justify holding the position. If the stock price isn't acting right, you're not going to hold it just because the earnings are good. But it's when we put all these things together at the right time, you get what I call the specific entry point, and that's what SEPA, specific entry point analysis, is about. Let me show you another way, okay, to look for acceleration. And these are all things that are going to be picked up and are going to be used by institutions. Institutions will run all this analysis, and it's going to all be basically around these techniques that I'm showing you. And here's the real key. You are an individual investor. You can make decisions very, very quickly. So you don't need superiority of information. You don't have to have information that's better information or inside information or any kind of informational superiority, because you have superiority of liquidity and speed. So what takes an institution weeks and months to make a decision and to buy a stock, it could take you literally a half hour. You can make this decision very quickly. What happens with an institution is they find a stock, their analyst starts following it, and then they say, hey, this stock looks like, they're starting to get earnings are accelerating. They bring it to the manager. The manager has to take that, and the analysts have to take that to a meeting. They have a meeting about it. It goes on an approved list, and from there they got to build a position. Usually they got to buy hundreds of thousands of shares, if not millions of shares. It might take weeks or months to build that position. It's a whole process that it's very lengthy. And this is why 80% of managers don't beat the S&P 500, because they're handicapped by size. You have this incredible advantage where you can look at the exact same numbers and have the exact same tools, but you're lightning fast. Think of it as a big cruise ship, and you have a speedboat. And if you want to turn that ship around, it's going to have to make a big, giant turn. Meanwhile, the speedboat, boom, turns around in a second, is going in the other direction. That's what you can do. That's your advantage. So another thing that institutions will look for is a material change in earnings. And this is what we call a breakout year. So what you do is you look back and you look at the annuals and you see if maybe the stock has been in a range. The earnings have been dormant and been flat, or maybe just slow growth. Maybe they've been growing at X percentage, and then suddenly you get a breakout out of that range. This is just another form of acceleration. Everything I've been talking about since we started talking about acceleration is all based on acceleration. So here we've got acceleration. So take a look at this example right here. 2006, 23 cents a share. 2007, 26, 2008, down a little bit, 18, 2009, 32 cents a share. Not much, right? For 4 years, it's basically range bound. And then all of a sudden, boom, $1.32, up 300%. And the estimate for the next year is up 47%, which still could be conservative. That's a breakout year. And you're going to find a lot of stocks. You can even look at the estimates. Sometimes if a stock is setting up and it's setting up technically, you can look at the estimates. You might already see some accelerating quarters, and it hasn't really shown up in the annuals yet, but you'll look at the estimate. You've got acceleration in the quarters, you've got the stock setting up, and you look at the estimate, and the estimate is going to be a big breakout year. Now it's just a matter of following the stock and making sure the quarterlies are playing along with that, with that picture. Here's an example going back. We're going to look at Gilead again. Remember, we had the quarterlies, right? Here's the quarterlies. Now, right here, see the estimate? The quarterlies are coming in, but if you look at the estimate right here, $1.85, $1.93, $1.95, $2.04, almost no earnings movement at all for 4 years, $8.01. Pow, up almost 300% breakout year. And now the stock's breaking out of the base, and everything is culminating and coming together to that one specific day that you're going to be buying at, which that's later. We're going to talk about the technicals. But so let's keep moving here. Okay, so now another way that you can look for earnings acceleration is looking at the current earnings versus the growth rate. Very often this will happen in turnaround situations where you've got companies or a whole industry that fell on hard times, and now you're getting a turnaround. Maybe there's the business dynamics have changed, or there's a new CEO of a company that's refocusing their strategies. Whatever it is, there's a company that wasn't doing well suddenly is starting to do well. Now, here's the caveat. I think we talked about this earlier. With turnarounds, you're going against what we call easy comps. So when you have a growth rate, especially if it's a very negative growth rate, let's say the growth rate is negative 50%, and now you start to see the earnings come in, well, you're going against very easy comps. They call them easy comps, which just means that you're comparing the current earnings to a small number or maybe even a negative number. So it's going to be very easy to appear to have a big earnings report. So with turnarounds, what we found is you generally want to have 2 quarters of triple-digit earnings before you consider the stock. Certainly one with at least the estimate of the next quarter being very strong, but generally you want to have a couple of quarters of very strong, and that's looking at your growth versus the growth rate, your current growth versus the growth rate. In this is a hypothetical situation, but you can see the 5-year growth rate is negative 7%. The 3-year growth rate is 12%. Nothing to write home on either of those, right? But look at the recent couple quarters, up 44, up 183, and then the next quarter is estimated to be up 900%. So huge acceleration from minus 88 to minus 7. So you've got the sequential. You might even have the breakout year, and now you've got acceleration versus its growth rate. This would be hitting on all cylinders of acceleration.
Yeah.
Go ahead, Dave.
I would say that also when you're talking turnaround situations, that you want to recognize these in their first or second quarter. Because if you wait until this has a great growth record and has been coming through with 4 quarters of earnings or even 6 quarters of great big earnings, lots of times these turnaround situations have already had their move. And you'll start seeing them show up technically after that first earnings report. People are going to recognize, hey, there's something going on here, and you're going to see that stock starting to take off. But especially in turnarounds, you got to catch them in those first 2 quarters of a huge turn in their earnings.
Right. And you're going to be using this all together with if you're using MarketSmith, of course, we have the trend templates. You can use what Dave was talking about earlier about having that 1-month trend template where you get those early turns, and you'll pick up a lot of turnaround situations with those early turns. You'll see technically the stock starting to turn, and you can go and see if it's got the earnings. Now, going back, we've been doing this for a while, but I use this page from the 2013 Master Trader Program workbook. Basically, I picked the stock that particular day or that particular Master Trader Program, and I picked Home Depot as a stock that I said, this is one that meets the criteria that I would look for right now. And I said, we'll revisit this a year later. When I come back, we'll see how it performed, and we'll just do like sort of an exercise here. So I picked Home Depot. Now you can see here it has a 4% growth rate, right? But see the earnings in the most recent quarters. You've got a couple quarters here: 39, 30%, 17%. Average of 29%. So that's a big acceleration versus the growth rate. That's one of the reasons why I picked it. You also can see that you've got the earnings in the quarterlies, 11, 19, 18, and then 39, 30, 17. You've got that if you were to average these out like we talked about, you've got acceleration in the quarterlies, right? So relative strength, 90, great. That's great. It's coming out of a little base here. You've got a bunch of things that really look pretty strong here for Home Depot. Now, the thing that I want to show you, we're gonna go back here, and we're gonna go back to talking about valuation and talking about analyst estimates. This is where I want to show you. Remember, I said there's the opportunity is in the analyst being conservative and them not being able to predict 4 quarters however many quarters out, however many years out. Well, take a look here. PE ratio is 21, right? The estimates, these are estimates, earnings estimates for the year, 297 and $3.37 for 2014, right? The visibility here, I mean, 2013 is right around the corner. You're in 2013, and 2014 is the very next year. Okay, we're going to fast forward here 1 year later. All right, this is looking at the year later. The stock now had a 90 RS, right? That's what it was when I showed you the other chart. Just going back here, 90 RS, right? 90 RS. Look, the stock made a pretty good size move here. It went from, I don't know, what was it, maybe $55 up to 90 or so, almost a double. But look, the PE is exactly the same. It didn't change. It's still at 21, right? Growth rate was 4%, right? We go back to the other chart, 4% growth. Now, growth rate is 23%. See, because the earnings came in, right? But here's the real key. The earnings estimates, if we go back here and we look, there were 297 and 337, right? That's this red circle right here. 297, 337. A year earlier, those were the estimates. Look what actually came out. 307, 376 in 2014. See, they were, not only were they off, but the further out you go, the more off they were. The analyst estimates were conservative. They're way conservative, and this is on a stock that is widely followed. Which, you know, they're covering this thing with all types of forensic accountants and all kinds of MBA, CFAs that are following this, and they can't get it right. Now, this is a stock that's only growing at 20%, 30%. Now, you kick that up to 100% growth, and they're not going to have a clue. They're not going to have a clue as to how to value this thing. And that's why they can make these huge moves, because they're completely inefficiently priced. All right, let me show you on the flip side now. This will really drive the point home. That next year, I did the same thing again at the 2014 Master Trader Program, except this time I said, I'm going to point on a stock that I think we should avoid here. That's the exact opposite of the criteria to buy, but it's in a stage 4 downtrend, and I would just avoid this stock. This is one that we don't want to be in. Okay, so we're already, you look right here, we're in a stage 4 downtrend, right? The relative strength is a 3, right? That's basically the highest relative strength in reverse. It's almost the lowest relative strength, right? PE is 22. You can see the negative earnings. You went from nice strong earnings of 97, 70, 69, these strong earnings to negative earnings. Sales also came down dramatically. Let's look at the estimates, all right? So we got 2014 of $2.67, 2015, $3.22, right? Let's make a mental note of that. Now, let's move forward and see what happened to this stock. Wow. I mean, you want to talk about a pretty clear picture here of making my point. So PE is 22. This right here is where it was right here. This is that chart, right? So we're fast forwarding to the next page. We're on page 90. So stock rallied a little bit, but ended up getting cracked pretty hard and is down substantially from there. And the PE is now 86. So how does a stock decline? They make this giant decline, and it's way more expensive because the earnings, look at the earnings, losses, right? Now it's saying NA because now it's negative. They're negative numbers. They're losing money. So you can't, there's not even a number that you can compare as a percentage. But here again, here's the real key. $2.67, 322, right here. There it is. 267, 322, right? Look what actually came out. 231, negative $1.20. They had this company earning $3.22 in 2015, and it actually lost $1.20. Huge.
And that's why, especially when a stock is in a stage 4 downtrend, you listen to the stock and not listen to the estimates, because the stock is telling you that they're starting to have problems, and it certainly came true.
And the analysts are slow to react. That's why you're listening to the news and you're watching Kramer and whatever your newsletters, and you're getting all this information. Believe me, you're going to do much better when you learn how to make these decisions based on the chart and the numbers, and you learn how to focus on these key things that we're telling you, that this is how you're going to beat the pros, get the big returns, manage your risk, and astonish people with, how do you do this? You must have this crystal ball. No, you know what to look for. You know how to respond to it. And you know how things work in the real world. See, this is real world. This is how it really works. And this is how I do it. This is how Dave does it. All right. So go ahead.
Yeah. The other thing, when a stock starts in a downtrend and the outlook for the company starts changing, I think analysts are almost reluctant to say negative things. I mean, you've seen in the past, they would show how many positive reports there were out on Wall Street, and it was, in the 90+%, of all reports are positive. And companies usually don't put out negative reports, and they also don't want to say negative things about companies, because they're actually going to get out of their good graces, and the company might not talk to them in the future and give them an idea of what's happening. So they're very, very reluctant to put negative reports out and even put out negative estimates.
There's a lot of politics behind this, and that's basically what David is saying. And so let's assume this was Amazon. Here's where an analyst is going to have a very hard time saying negative things about a company that has had declines in the past. It probably had a bunch of these declines, 20, 30% declines, even 50% declines that the stock came right back from and then went up 500% after that, burned time and time again, where if they got negative, they would have been burned hands down. Well, that's what happens now that the stock finally tops, and a lot of times they're actually putting out as a buy. You'll find that these brokerage firms are buying these declines in these big names because they're looking myopically, and they're so convinced that this company is so strong that. And then maybe the stock bottoms for a little bit, but that's when the trouble starts brewing. And then finally, when it's getting really obvious and the numbers really start turning, then all of a sudden, everybody starts to agree. And now that whole agreement theme happens all over again. And now you set up for a positive surprise. You see, it's the exact same thing. Remember, we're going right back to that maturation of the earnings maturation cycle with the surprise models, and going from value to growth, from growth to value, with the surprises on the upside, surprises on the downside. That's all set up and driven by the analyst being slow to react, and the stock not being efficiently priced. And the higher the growth, the more difficult it's going to be to value that stock, and the more inefficiently priced it's going to be. And that's why the high growth companies can make these huge moves. You get into a company that's growing at 8% a year and it's a utility, that can be valued pretty accurately. All right. That's why we're not going to bother with that. We're going to go in areas where there's potential inefficient pricing, and we can get this monster move, or even a velocity move where the stock doubles or triples just in a few months. And that's where you make the big money, because you're compounding very rapidly. So this should really, whenever I show these slides right here, and I show this estimate and show how off, the analysts were, it just light bulbs always go off. This is whenever we do the live events, people come up to me afterwards and they're like, wow, that really made a big point, and really let me see, what's going on here, and why these stocks are able to make these moves. So real quick, I'm not going to go over these, but how do you know if an earnings report is really great? This is 7 things that you can look at to judge if an earnings report is a decent earnings report. And like David said, what's really important is the response, and the response to the earnings, and the response to guidance. If the initial response is very important to see how it initially responds, but what's even more important is subsequently, is there subsequent strength? And if the stock does come off on the earnings report, is it resilient? Does it come back very quickly? Looking here at Netflix, you can see they had an earnings report. It gapped up big and then pulled back a little bit, and it was able to get right back a new high ground. And that was it. You got that post earnings drift because this report was a good report. It truly was a good report. Now, you could have had that same report and the same news on the surface, but if the stock broke, that's not going to be a good report. Even though it's the exact same news, depending on how the stock acts, if that stock was down 15%, I'd conclude that that's a bad report. All right. So now we're going to move on to, we talked about earnings and sales, and we didn't talk much about profit margins. So we're going to move on to profit margins. Now, again, you just saw the power of just earnings and sales, and we sliced and diced these numbers. Now I'm going to show you how to really turbocharge this whole thing to the ultimate level, and that is adding profit margins in. So, and I'm going to give you some examples in just a minute, but just let me show you a few stocks here and show you how profit margins also drive the stock price. Taking a look at Apollo. Remember, I showed you how we had these nice strong earnings, and in a bear market where the Nasdaq was down 60%, Apollo went up 850% during that same time. During that same period, the Nasdaq dropped 60%. I mean, that is outperformance at its best. Look at margins: 11.7%, 14, 16, 18.4. So you're not only getting acceleration in the earnings and the sales, you're getting acceleration in the margins. And all of this compounds each other. And I'm going to show you that in just a second. Let's look at Panera Bread, another one that's just amazing relative strength against the market, almost completely inverse. But look at the margins. The margins started at 4.7% back in 2000, went to 6.5 in 2001, then from 6.5 to 7.8, and then from 7.8 to 8.6. So the margins essentially doubled. They were making double the amount of profits a couple of years later. And again, that was a big part of this big move that, like I said, completely inverse. The Nasdaq during this period was down 80%. Okay, that's not a mistake. 80%. So again, if you think the market is so safe, if you didn't live through this, maybe you might think that. But when you live through a couple of these bear markets, you start to realize that even the Nasdaq, even the Dow or the S&P 500 can go down precipitously and go down for a long period of time, and that it's the market's very dangerous. And but if you're in the right names, it could be very profitable, right? Monster Beverage, here you go, from 3.3 to 5.4 in 2003, then from 5.4 to 11.3, from 11.3 to 18%. So you went from 3% to 18% margins. Meanwhile, your sales are 20, 63, 93. Well, that's why the earnings are up huge: 75, 214, 195. This is what drives this big price move.
Yeah, and what created those great margins was an introduction of a new product, actually even a new category in drinks with high caffeine drinks, and that's what drove those margins because the sales just exploded.
Yeah, I can't remember. Dave, do you remember if I talked about the cola market and 7-Up? I can't remember if I might have told that story. If I already told it, pardon me, but I'm going to tell you again. Back when the colas were before 7-Up, 7-Up came up with a brilliant idea. They took out the color of the cola, and they came out with something called the Uncola. 7-Up their slogan was the Uncola. That category did not exist. There was no Uncola. There was colas, and colas were browned. So he took it out, made it clear, called it the Uncola, and created their own category. And again, that's what Monster Beverage did. That's what Coca-Cola did in the I guess it was the 20s, or it was definitely the 30s, but maybe even the 20s. Coca-Cola came out, and Coca-Cola was this great, beverage, this new beverage that took the world or the country by storm. Same thing with Monster Beverage. Nothing different. If you go back and you look at Coca-Cola in the 1930s, it had the earnings. It looked like Monster Beverage. It had the same earnings. It had all the characteristics. Now, I want to show you something. Another light bulb moment here is going to be in these next two examples. So this is a hypothetical little grocery store. It would be a very little grocery store. There's $1 million in revenue. I just put this together just to make an example. It could be anything. But let's look at, I want to show you the power of stacking these the earnings, the sales with the margins and how it affects earnings in an exponential way, in a compounding fashion. So you have a company, $1 million in revenue, profit margins of 1%. The reason why I said a grocery store, because 1%, grocery stores operate on 1 to 3% margins, very, very low margins. So let's say you got a market cap of 100,000 shares, right? So $1 million times 1% equals 10,000. 100,000 divided by 100,000 shares, that would be 10 cents per share. If this was a public company, they would have earned 10 cents per share if they made 1% margin. So revenue is now up. Let's say 25% they grow the revenue. Okay, profit margins of 1%. So now you take 1.25 million times 1% equals 12,500 divided by 100,000 shares. You have 12.5 cents of earnings per share, right? Earnings would be up 25%. Margins are the same. So now sales going up 25% are going to increase earnings up 25%. Okay, let's do scenario B now. Now revenue is up 25%, just like in scenario A. We went from 1 million to 1,250,000. However, margins are going to go up just 1%. Okay, we're going to go from 1% to 2%. Now we take that 100,000 shares, 1.25 million times 2% equals 25,000. 100 divided by 100,000 shares is 25 cents per share. Now, instead of having 0.125 cents per share versus 10 cents per share, we've now got 25%, 150% earnings versus 25% earnings. And all we did was move the margins up 1%. Now, mind you, those margins are double. But this is the power of margins, because you can get a company that has 3% margins, and like the case of Monster Beverage, they grew from 3% to almost 19%. That's way more than double, and at a much larger number. So it's you're compounding and you're exponentially growing your earnings when you start growing your sales with expanding margins. And this is where the real power comes in, when you start adding these elements. And this is how a stock can make a huge move. Let me show you a stock that is near and dear to David's heart. Ollie's Bargain is a stock that David and I both bought a number of years back. Actually, we did a master trader program, and David came into town to do the master trader program, and there was not an Ollie's where he lives in California, but there was, right, and there still isn't, and there was one near where I live. So we went to Ollie's and saw the store. Anyway, taking a look at Ollie's came out with some nice numbers right here. This is just a value line sheet. Margins were up 42.6%. Revenue up 16.8%. Earnings were up 50% from 2015 to 2016. Now, those margins went from 4.7 to 6.7. That's just 2%. Okay, but it is a pretty big move. It's 42.6% move in margins, but it's just 2%. They improved their margins by 2%. Now, that revenue of 16.8% produced, with those margins, that margin increase produced a 50% earnings per share. Let's just say that the exact same scenario happened, but they didn't increase those margins by that extra 2%. Well, these are the numbers here. If they kept it at 4.7%, earnings would only be up 7.81%. From 50% to 7.81, all based on just that 2% in margin growth. So you can imagine, what would happen to a company that's growing their revenue and growing their margins like a Monster Beverage. Well, now, what is one of the greatest companies of all time that is one of the greatest growth stories of all time? And now they're calling it the Great Turnaround. You know what that is? You know what that name is? Apple Computer. Why? Because Apple Computer was almost out of business. All right. They were almost under. A lot of people don't realize that Apple was on the balls. I mean, they were almost completely under. They were down to margins that were negligible, actually less than 1%. In 2003, they had 1.2% margins. Look at the growth story here. Look at the margins. They went from 1.2% in 2003. By the time they got to 2011, margins were 23.9%. Oh, a 20-fold increase in margins. And you wonder why Apple is Apple? There it is, right there. When you have the revenue growth and you have, and now of course this is all driven by new product cycle. They had the iTunes and the iPad, and much of this happened before they ever even had the iPhone. The iPhone was later. Now, iTunes, I think, was the first thing they had, and the products. There was the what was it?
it was the iPod that first came out in 2003, 2004.
The iPod, yes.
Yeah, the iPhone actually came out in 2007.
And iTunes was iPod, iTunes. I had the chart before. Wait, I think I still. Hold on, let me just see here. I thought I had. Oh, I had the chart earlier. I think.
But yeah, the big thing was in 2007. They brought out. They put a phone onto the iPod, and so you now get an iPhone. That came out in 2007, and then we went through a tough market, and the stock pulled back. But then from there on, it just took off.
Yeah, and I'm trying to find and settle this once and for all here. Let me see. Hold on. What page is it on? I'm sure some of you know this already. Let me just see if I can find it real quick. Hold on. I'm sorry to stall here. Here it is. Here it is. The turnaround situation. So here, Steve Jobs comes back. iPod released here, 2001. iTunes, 2003, and then the iPhone is out here in 2007. Yeah. Right. All right, so let's go back. What page were we just on? I know I'm skipping around here, but sorry about that.
It's like 90 something.
Yeah, profit margins right here. Here we are. Right. So so by the time we got over here, we moved over a couple of years, the margins had already gone up 9 or 10-fold, right? So now the bottom line of all this is what we call the code 3. I call the code 3 matrix. And basically, what I'm trying to ascertain when I'm looking at acceleration, I'm trying to see how attractive the fundamentals are based on looking at the last 3 quarters. Look at the last 3 or 4 quarters, look for the acceleration. And basically, if you've got acceleration in earnings, that's great. If you've got acceleration in earnings and revenue, that's even better. And if you've got acceleration in earnings, revenue, and margins, that's your best scenario. That's what I call the code 33 stock. So what I'm looking for, and these are just rankings, if it would be, if you had 1 quarter of earnings acceleration, that would be one that would be an 11. A 33 would be 3 quarters of all 3. So this is built around what institutions are looking at. A lot of these funds that are quant funds and they're running these these computer models. This is what they're looking at. And they take a long time, like I said, to make these decisions. You could do this analysis very quickly and be getting in that stock at a moment's notice. This isn't going to take very long. And the thing about MarketSmith, one of the reasons MarketSmith, of course, is our sponsor, but I've been using MarketSmith, and I should point out that we've never had anybody else sponsor us, and MarketSmith has never sponsored anyone else. They've never sponsored any outside seminar other than their own O'Neill seminars. So it's we have a liking for both of us. They feel strongly about me. I feel strongly about them. The reason why is because I've been using MarketSmith in one shape or form or another for 30 years. David is instrumental in creating what is in MarketSmith. He was at O'Neill and Company, 3 decades ago, creating all this stuff and creating the going around teaching CanSlim and creating this product before it was even MarketSmith. It was Daily Graphs printed, and then it was Daily Graphs online, and then it went to MarketSmith. As a matter of fact, where are my books here? I had them. I have the books, Dave. I'll show them later on.
Original Daily Graphs.
I got some original Daily Graphs. You must have some laying around too, right?
Yeah.
When we first started doing this, we were using printed books, and the books were weekly. And then throughout the week, we'd have to update the charts by hand with pencil, or imagine where the stock price was. I was trading by imagination in the beginning. Like, I didn't even have charts. I had no real-time charts. I was getting the newspaper and then eventually getting Daily Graphs on the weekend. And then throughout the week, I had to imagine where the price was, and I had to fill it in. I'd write it in with a pencil and kind of draw it in crudely. And then the next week, get the next week and see how close I was. So very archaic way of doing this, but again, all this is built around the information that you have readily available in MarketSmith, because O'Neill and David and the folks at MarketSmith, they base this all upon how the real world works, and boiled it down to the information that you need to focus on that actually influences stock price movements. There's the problem we have now is you have information overload. There's so much information. You've got to peel back the onion and try to get to what's the real important things to concentrate on. And that's what this whole workshop's about, is to give you those rules and the things that you should. And you might be saying, oh my God, this is so much. Code 3 matrix and earnings and acceleration. It's a lot more straightforward than you think, and it's going to be a lot easier than you think. Once you get involved with this and you start to learn how to do it, it's going to be very quick. You'll have all the information right there, and boom, you'll be able to make these decisions very quickly. Okay, there's another slide here, just some fundamental things to watch. Again, I'm not going to go over this. This is something that you can just look at for yourself. We're going to wrap this up, and we'll be coming back and getting into more of the technicals. There's a lot to go on the technicals. A lot of, I know a lot of you are really eager to see the technical analysis and the price patterns and all that. We've got that. We've got risk management. We're going to be talking about IPOs and all kinds of stuff here. There's way more to go. We're still at a level of, I would say, and maybe just starting to come in on an overhead view, where we still haven't gotten to a really close microscopic view and gotten to the buy points and really analyzing things, fine tuning them. But we're giving you from that satellite down to an aerial, and now we're just starting to come overhead, and we're going to start looking overhead on some of these stocks. Dave, anything to wrap up here as far as fundamentals are concerned?
Well, it's if you want the full picture, you want a stock that technically is acting well, that from a fundamental standpoint is acting well. When you combine those two, it's extremely powerful, and that's where you get some very, very big moves. And when it comes down to it, within a year, you don't have to find 50 of these. If you find 2 or 3 stocks that have these characteristics, and you treat them right, and you make them fairly large positions, you can do extremely well in the market. So it's just boiling 7,000 stocks down to just a handful of stocks that you can do well off of.
Right. And one last thing I want to follow up on, and that's off of what David just said. Whether you're and again, we're moving forward, and everything that we're telling you, nothing changes. If we go forward, we start talking about some new techniques, it's all built on the previous information. So everything's being built upon that. Whether I'm buying for a swing move, a quick trade, or a long-term investment, I'm still requiring all these characteristics. So like Dave said, one stock can change your life. I mean, if you happen to be in a big mover and you get a key leader, coming off of a bear market, and you're in the next Amazon, the next Google, could be life-changing. It can also be life-changing if you find that same stock and you trade it a bunch of times, or you trade a handful of names and you're in very quick moves. But the characteristics are going to be the same. You're looking for the exact same characteristics. Then it's a matter of position management, risk management, all stuff we're going to get into later. So just keep that in mind, that this is going to apply universally across whether you might be thinking, oh my God, I'm a short-term trader. I'm not going for these big giant moves. I'm not holding for years. No, this is not going to apply just to that. It's either whatever your time frame is, this is going to apply. All these rules are going to apply. Okay, so we have so much more to go over. I mean, we haven't even scratched the surface yet. You're probably already going, whoa, this is a lot, but we have not even scratched the surface. Some people that have come to the Master Trader Program have said and commented, I've heard this comment quite a few times, it's like drinking from a fire hose. We're bringing a lot at you. It's going to get more and more advanced as we go on. The information is going to come even faster and more sophisticated, and it's going to get more and more advanced. So, we're building here. We're starting off slow, and we're going to accelerate this as we go. So be prepared. There's more to come, and we'll see you in the next session.